Engulfing candlestick patterns. The engulfing pattern needs two trading sessions to evolve. In a typical engulfing pattern, you will find a small candle on day 1 and a relatively long candle on day 2, which appears as if it engulfs the candle on day 1. If the engulfing pattern appears at the bottom of the trend, it is called the bullish engulfing pattern, and if the engulfing pattern appears at the top end of the trend, it is called the bearish engulfing pattern. Let's have a look at bullish engulfing. The bullish engulfing candlestick pattern indicates bullish reversal, which shows a rise in buying pressure. This pattern indicates a reversal from downtrend as more buyers enter the market and move the prices up after a long downtrend. So this is what it will look like, where there's an ongoing downtrend, then there's a green candle that completely covers the body of red candle. This is what we call as engulfing, and this indicates a reversal, or the downtrend now gets converted into an uptrend. So the pattern, it consists of two candles where the second green candle, it completely covers or engulfs the body of previously created red candle. Now we should always remember that whenever we are trading with bullish engulfing pattern, the previous trend should be a downtrend. And additionally, we should always use additional signals. That is, I will confirm the reversal signals given by this pattern with other technical indicators. Next one is our bearish engulfing pattern. The bearish engulfing pattern is the opposite of the bullish pattern. So it signals a reversal of the uptrend and indicates a fall in the prices by the sellers who exert the selling pressure when it appears at the top of an uptrend. So this pattern, it triggers a reversal of ongoing trend as more sellers enter the market and they make the prices fall. So as you can see in the picture, there's an ongoing uptrend, but then there is a formation of this big red candle that completely engulfs the green candle, indicating beginning of a downtrend or reversal of uptrend into a downtrend. Now, how do engulfing patterns work? First, they act as trend continuation. That is, engulfing pattern, they support the continuation of the ongoing trend, meaning if we spot a bullish engulfing pattern in an uptrend, it indicates the ongoing trend will continue. They act as reversals. That is, bullish and bearish engulfing patterns, they always signal reversal in the trend. When a bullish engulfing pattern is found at the bottom of downtrend, it signals uptrend reversal, and when a bearish engulfing pattern is found at the top of an uptrend, it signals a downtrend reversal. Last but not the least is your exit strategy. That is, we can use engulfing patterns as a signal to exit if we are holding a buying or selling position in the ongoing trend that is going to come to an end. So here's a table that summarizes how engulfing pattern they work, what are their characteristics, and what signals they indicate. Now, what are the key takeaways on bearish and bullish engulfing pattern? The bullish and bearish engulfing patterns, they involve two candles where the second candle would completely cover or engulf the body of the candle formed on the previous day. The engulfing candlestick can be bullish or bearish based on where it forms with the ongoing trend. The bullish engulfing candle, it signals reversal of a downtrend and indicates a rise in buying pressure when it appears at the bottom of a downtrend. And similarly, the bearish engulfing signals reversal of the uptrend and indicates fall in prices by the sellers who exert the selling pressure when it appears at the top of an uptrend. Last, engulfing candles, they help the traders in spotting the trend reversals. They also indicate trend continuation, and traders can plan their exit accordingly using these engulfing patterns.